All right, how's it going, everybody? Another week, another barbecue, weekly grill, whatever you want to call it. Another couple of stocks that I've looked into and spoken to the management of. There's what do we have here? We have a silver producer slash explorer. There's a copper explorer slash developer. Actually, this is Canada's highest grade open pit copper MRE that was published, updated MRE that was published this week. So I had to figure out what this is about, what's going on. And then there's also an aspiring tin producer with assets in the UK. So I suppose loads to talk about. As always, though, fair disclaimer, non-honest confession. I have no idea what I'm doing. And none of this should be used as independent research nor as investment advice. I've never made any serious money in this sector so far. So just look at these conversations as what they really are, which is general and impersonal private conversations between two talking heads on the internet, both of whom you've likely never met. And I hope your mom taught you not to trust strangers, and definitely not when they're on the internet, because it's the internet, I suppose. Please instead head over to setterplus.ca and consult the company's official filings, as well as talk to a professional, hopefully a sane investment advisor, before taking your own decision in the end, because the mineral exploration, development, and mining industry is among the hardest industries to profitably deploy capital in, as there are many risks not typically visible to the naked eye, and you will lose all of your money if you don't do enough research and if you don't know what you're doing. In addition, I want you to know that I own shares of QC Copper and Gold, which is one of the companies in this video. And that makes me biased, to say the least. And none of these companies have, that you're going to see in here, none of them have paid for the production of this video. But that doesn't mean you should think of this as independent research, again, as I mentioned at the beginning. On top of all of that, these conversations are going to include forward-looking statements about uncertain events that may or may not happen in the future. There is a disclaimer on your screen right now. Please pause it, read it, unless you like losing money, and then feel free to move on. Because first up this week is Sebastian Wall, VP of Corporate Development over at Silver X. This is the silver producing company attempting to grow through organic exploration on their two projects in Peru that I was telling you about. Companies listed on the TSX-V under the ticker symbol AGX, where an average of about 150,000 shares trade each day, with a 52-week high of 47 cents and a 52-week low of about 17 cents. With a market cap of nearly 40 million Canadian dollars and about 165 million shares outstanding, today this is a 24-cent stock. There are 14.5 million warrants and about 7.5 million options that are still outstanding. So that's resulting in, give or take, 190 million fully diluted shares. Major shareholders are probably on your screen right now, showing 17% of management ownership, 23% of institutional ownership, and so about 60% or so of retail. As of the end of September of 2023, the company had a little over $500,000 in cash, as well as about $500,000 in prepaid expenses. On top of that, I had $4.5 million in account receivables and $750,000 in inventory, resulting in $6.2 million of current assets, which sat against $21.2 million of current liabilities, mostly made up by account payables. That sat on the balance sheet in September of 2023. That's the last financial report that I could find. Although the working capital might be a bit different by the time people are listening to this, because they did a royalty deal at the beginning of Q4, which will again show up in the full year financials, hopefully sometime during this quarter. The company spent about $2.5 million during the first 9 months of the year, keeping the lights on, which results in about $250,000 a month in G&A, give or take. Again, that's only over the first 9 months of last year. This is a silver producer, so they do generate some revenue, about $11.5 million during the first 3 quarters of last year. But the mining and processing costs came out a bit higher this time around, so there is no positive cash flow for the moment, although this will be a point of the discussion today. The production comes out of the Nueva Recuperada project, which is located in south-central Peru, about 500 kilometers south of Lima. The land package this project is located on is rather large, so it's over 20,000 hectares, but a lot of the historical production has really come from a radius of about 30 kilometers around the spot where the plant is today. And when I say historical production, this plant has been in production for about 60 years, producing what is estimated to be over 200 million ounces of silver. The project didn't operate without a break, though. It was actually turned off for about 5 years between 2014 and 2020 due to the bear market in metals prices. And Silver X is now ramping up, or trying to ramp it up to its 720 tons per day nameplate capacity. This is again Peru. It's precious metals, so you probably already know that this is an intermediate sulfidation epithermal vein system that contains other goodies besides silver. So, for example, like gold is in there. There's also base metals, of course. Veins are not the thickest ones you see out there, but typical for these type of systems, they are high grade. So they range between 0.5 meter to 3 meters of width, which is about a foot wide, give or take. Which is say not very wide. This requires a special mining method because it's not very wide, and this is called the long hole stoping method, which I always kind of describe as is picking out the chocolate chip out of chocolate chip cookies without breaking the cookie itself. Only in this case, it's multiple cookies stacked on top of each other, and they're picking the chocolate chips from the cookies below and working their way up in sort of a bottom-up way. The project, as it stands today, shows an M&I resource of about 35 million ounces of silver equivalent, but really only, to my calculations, 22% of that is actual silver. So there is more gold, and there's also a bunch of lead and zinc in there. And then in the inferred category, there's even more silver. It contains about 117 million ounces of silver equivalent, almost half of which is recorded as actual silver. Again, these numbers come from only a small part of this whole land package, so there are a few other target areas on here, including a development stage a project on the same land package, and also 4 exploration projects, all within the same land package. But if we move down a little bit more to the south, then there's another exploration asset on land package of its own, and this is actually a gold asset. It's called the Corioko project, but I suppose more on that a minute later. I suppose you've heard enough of my voice. So Sebastian, let's talk about silver production here. And where I want to start it is maybe not your favorite place to start, but it's a point of discussion nonetheless. All-in sustaining cost is now higher than the spot price, as the last recorded on the presentation. So talk to me about that. What's going on, and how do you get this back on track?
Well, first of all, thank you very much for having me, Antonio. It is absolutely correct that, in particular, compared to our results last year around this, last quarter in 2022, we had all-in sustaining costs for around $15, and they have increased in 2023. That is absolutely correct. It's one of so first of all, I would say it's not the geology, it's not the resource that is weak or not ideal. We have made some decisions, in particular in the spending, that haven't been the smartest, and we're correcting them. As you just mentioned in the introduction, we also halted the operation for a brief moment of time in September, which obviously impacted the overall cost structure. So costs continue to rise, but continue to go on, but we're not producing at the same time, so that obviously impacts it. And that was mainly due to, let's say, an operational reset, correcting the mistakes that we made throughout the year. And we believe that our actions will yield in the first and second quarter of this year. And we hopefully get back on track, reducing our all-in sustaining costs. Obviously, neither shareholders nor management were happy with this, so we are working on correcting it.
What's your expectation, if you can tell me any internal numbers of what it's going to be in 2024?
It's challenging to say because we are still not on full capacity when it comes to the operation. You need to understand this was a project that was developed with reasonable amount of funds, if you will. So we were never able to do the things to the point like big mining companies could do that, right? Deploying a ton of capex up front and then maintaining with a low OPEX. So that obviously influences the results a little bit, but we have a very clear goal, and that is namely to control the costs, control dilution, and improve the volume. Our asset is permitted for 720 tons per day. At the moment we're doing around 450 tons a day. So we're not utilizing the entire potential that we have. So that's our main focus, reduce costs, improve operations, streamline things, keep our heads down, and just do a good job in improving what we have.
And then ramp up that production, as you said. I do want to talk about that a little bit later on. But what I'm thinking is, you said it's not the geology of the project or anything like that, but as far as I understood, and that must have been Q2 actually of last year, you did encounter sort of low, pockets of low grade mineralization here and there. Um, so maybe talk to me about that. Like, how much of that is under your control? Like, how do I, and more importantly, how do you know you won't keep encountering those in the future?
I think perhaps it's important to take a step back. So we're currently producing in the Tangana project,
Mm.
right? The Tangana project is a multi-vein deposit. We're currently operating on three. And in the entire district, we're having about 200 veins that are outcropping, right? So it's important to understand that in the context of developing a district scale project, the current operation is nothing else but providing us with, a bottom line to continue to grow the district. So we have done quite a lot of work in terms of exploration and development to really understand our existing operation better. We are actually producing what we anticipate to produce, and obviously, the more you work in a mine, the more you drill, the better you understand it. Since we only started commercial production early last year, with every quarter you do, you understand your asset better and better, right? That being said, there's absolutely no excuse. We need to improve what we're doing. Our focus is to have a solid cash flow out of the Tangana mine, but in all of this in the context of understanding the entire district much better, right? So, as I mentioned before, in the 20,000 hectares that we have over 200 veins that are outcropping. So there are a lot of deposits that are a lot richer, a lot better, but you have to start somewhere, right? And for us, this was the Tangana mine. But we're very confident, and in particular, if you look at the PEA, that the growth potential of the district is very good. But it's going to take some time until it's going to yield the results that we want to see.
But so grade control, I mean, controlling the grade of what you're mining. But like, how do you even think about? I don't even know how to ask this question, but I'm just thinking, how do you think about it? How do you look at the whole thing?
I'm not sure if I understand the question correctly, but I mean, from my point of view, I'm a shareholder, I'm part of the management. So obviously, the way I look at it is what's important is that you control your dilution, right? So that during the production, as little waste rock as possible gets into your ore that you later then process, right? I think that's a critical factor. That's something that we always have an eye on, right? And everything else is just about controlling costs. You can't control your grades other than dilution. So you can control volume, and then you can control your costs, right? We have an average rock worth $150 per ton, approximately, in the Tangana mine, right? So our job is to whatever is below, we shouldn't be producing. We need to make sure that our costs are substantially lower than that. And at the end of the day, it's a very simple business, right? And that's what we're focusing on.
Well, simple but not easy, I suppose. And what else has been sort of a roadblock, maybe a little bit, has been community issues, really. I'd call it community relationships, but maybe the community issues. And so you have since signed an agreement of sorts, a 12-year agreement. But talk to me about that. What exactly does that cover, and how do you see the risk of further escalation there?
There was never an escalation, rather the opposite. So we are in a historic mining district with decades of mining experience. The asset that we have today never really existed the same before. So we consolidated an entire district. We bought an asset from Buenaventura, from Pan American Silver, from other mining companies, and we consolidated a district in a historic mining area. Okay, so there has been mining for decades, and the negotiation that we had were just to make sure that in the context of a district development, we have the community support, right? We published a PEA early last year explaining the business concept or showcasing how we can grow to 2,500 tons in terms of silver equivalent. That'll be $5 to $6 million annual production. And the resources on that PEA suggest a life of mine of about 12 years. So in order for investors to understand that we are doing all of this with the support of the community, we extended a community agreement for 12 years, which is, by the way, almost unheard of in Peru, in particular in current times, right? But this clearly shows that we are in a district where we have the support of the community. Obviously, everyone has their ask. They want to participate in the growth in the economy, but overall, they're standing behind our growth plans in the district.
Where I'm coming from with this is because when you look at some of the larger producing companies and issues that they've had over 2023, I mean, that was notable, right? It even made a dent in global copper production. So how do you think that's going to develop as you're growing this mine? Do you think people generally are against larger mines, or is it region dependent? And how do you look at it?
Yeah, so I think there are various factors play a role. So obviously, if you are a large mining company, a really big one, it is attractive to take a big name hostage for a political statement, right? If you are a smaller company, that might not necessarily be the case, right? So Silver X, in that sense, I want to say, is not necessarily exposed of being held hostage, because it plays a role locally, but not nationally, right? As simple as that. One role is, and you just mentioned that, is the location of an asset, right? Sometimes mines are being developed where there were no mining activities in the past, right? And then you have an asset like ours that is being developed in a district where mining has been present for hundreds of years, right? So for us, we're very blessed in that sense, because the young man and women that work for us today, their fathers worked in the mine, their great-grandfathers worked in the mines, and so on. So we don't have to explain to them what we do. There's no education necessary. Rather the opposite. We are close to a community with a lot of, I want to say, talent or potential workforce for the mine. There are other mining companies in the area, meaning they're small companies or service providers in the community that provide services to mining companies. So that makes it fairly simple, because I don't have to tell them, or we don't have to explain what we're doing. It's the other way around. They want to participate in the activities. They're looking for jobs. So this is a two-way street.
Do you have an idea of what percentage of the GDP of the region, not Peru, but the region specifically, comes from mining and mining related activities?
That is a very good question. I would say in the municipality or in the community where we are, way over 50%. I would say probably even more, like 70, 80. I mean, you need to understand the mine that we have. Our neighboring mine is producing about 1,500 tons. So they already went through the growth process that we have ahead of us. And us, we are, I want to say, perhaps the largest employers in the area. And there's little other activity. These two mines that I just described are up on 4,500 meters altitude. there's little other business. There's no tourism. There's little to no agriculture. There's some alpacas, right? But there's little alternative businesses. I mean, I always like to share this experience when we consolidated the assets and reopened it. There were actually people that left the area because they couldn't get any jobs. They moved back to their homeland, right?
Mm.
To where they come from, to where their families come from. But all of a sudden there was work again. So there's a big connection between the people, their land, and then also mining, right? So it is a driving force in the area, absolutely.
Mm. Do the alpacas like you? Have you touched one?
We visited a few alpacas, yeah. So when you drive to the mine, you actually drive through fields where they run around. You can see them. It's very nice, yeah.
Never seen an. I don't think maybe in a zoo I've seen an alpaca. I don't think so. Anyways, but 4,500 meters altitude, does that limit you in terms of labor as to who can come and work there? Like, is it only locals? Because it's not easy working at 4,500 meters altitude, right?
It is not, but you get adjusted fairly quickly. So as soon as you spend a few days up there, you're completely adjusted to the altitude.
Mm.
Yeah, over the last few years, we had, a handful of cases of people that suffered from altitude sickness, but the locals up there are they're completely fine with it. So that's yeah, it's. I mean, obviously, it is not next to a highway, right? So it is up in the Andes, but again, the streets are wide. People know how to work. They work very hard. We're connected to the grid, by the way. We have fresh water, so you have everything you need to do mining at a reasonable expense, a reasonable cost.
Hmm. So your labor, where does that come from? Is it primarily locals? Do they come from someplace else?
I think about 65% of our workforce come from the closest town. There's
Hmm.
a town about 3,000 people.
How far is that?
By car, about 20 minutes. So
Okay.
it's basically just between the mine and the plant. It's a small village called Huachocolpa.
Hmm.
Um, and you get everything there that you need. And about 65% of our workforce come from there. And then obviously, occasionally you need experts that you bring in from elsewhere.
Hmm. Okay. But that's not, I mean, what you're saying here is that this is not new to the region. Like if they look at their grandparents, it was probably the same composition. The town was mostly employed by the mining sector in the region for like decades in the past.
Exactly.
Mm,
Yeah.
mm. Okay. Okay. What is your overall, knowing all that community is okay? I mean, you understand the geology and you understand what you have to do. What's your 2024 outlook in terms of production, but also not only absolute amounts, but also relative, as in what percentage of your production is going to be silver this year?
It's a very good question. I mean, we do have gold in our system,
Mm,
and if when you calculate the equivalent price, as soon as you have a little bit of gold, it moves the needle quite a lot, right? Simply due its value, right? I would say that roughly 60% of our revenues come from 60 to 70% of our revenues come from precious metals, and the remaining 30 to 40 come from base metals. Okay. Um, that's sort of like a little bit how I see it. In terms of 2024, I think our key objective for 2024 is execution, right? It is, we own the asset, we have the permits, we have everything in front of us. We just need to execute on the production, right?
mm,
Which ideally should be around 1.8 million ounces silver equivalent, give or take.
mm.
That'll be a satisfying 2024. And then obviously cost control, that's key in the
Mm.
context of production, right?
You said most of that, so over half of that is going to be precious metals. If we take that half and split it, would the bigger half of the precious metals half be silver, or would it be gold?
I want to say it's predominantly silver,
Mm.
perhaps two-thirds silver, one-third gold.
Okay.
but obviously that also changes a little bit. I mean, ideally, at this point in time, we're not quite there yet, but ideally you want to have several stopes fully prepared. And at the end of the day, you want to be able to manage your production, that you always reach the, as mentioned before, the $150 per ton sort of value. And then you have pockets that are a little richer, pockets that are not that rich, and you want to manage and mix that. But I want to say, 2/3 to 1/3 might be fair. Sometimes 50/50. You can't really control that, on a week-to-week base. Over the year, I want to say 2/3, 1/3.
Right.
Hopefully.
That's exactly what I'm wondering, because as the precious metals are running in price, hopefully in 2024, if we see more, if we start seeing rate cuts, not more rate cuts, but if we start seeing rate cuts, then you would assume gold would move first. So the question would basically be, do you have the ability to go in the gold-rich zones and focus on gold before silver starts running, and then focus on silver and manage it that way, basically? So that's where I'm coming from. Okay, so I think I understand the sort of the 10,000-foot view perspective, if you will, but I'm also wondering about the 20,000-foot view, if you will. And so in your presentation, you say that you want to have a 4x resource growth and a 3x production growth by 2026. That's basically 2 years away. Well, if it's the end of 2026, it's about 3 years away. And so it sounds like an aggressive timeline to me, which always makes me think about, obviously, money. It's a capital-intensive business. So talk to me about that. How much money is it going to cost you to ramp up to that place? And, well, obviously, where is the money going to come from?
Yeah. So if you look at the PEA that we have published, obviously this is done by external consultants. They came up with a capex of roughly $60 million US to develop the mine and the plant to produce roughly 2,500 tons a day. And those 2,500 tons translate into between 5 and 6 million ounces silver equivalent, which is your 3 to 4x in terms of production. So we have a clear understanding on how much it costs. I believe we can probably do it a bit cheaper than what consultants say. Still, the PEA is still attractive. It's a 40% IRR, a 230 million NPV on a $60 million investment. So I believe it's not a huge project, right? But I do believe that it's small, it's attractive, that with those numbers, that's a payback period of I think less than 4 years for investors, that we can attract capital to execute on that. So as I mentioned before, perhaps to complement this, is one thing was the agreement with the community, that investors understand that this is not just a PEA, but the people that work with us and that own the community are with us as well. The other thing is the environmental impact assessment. It is sort of like the last puzzle piece, if you will, in terms of permitting. Okay, that's a process that takes roughly 2 years, and we've started a process almost 2 years ago. That's a process that you do parallel with the government. So that is fairly advanced. So in 2023, we should complete this and have our environmental impact assessment. And with that, you have everything to execute, right? And then obviously you need the market environment and the commodity prices to attract capital. But I believe we've done our homework. We own the district, we consolidate the district. There's proof of concept with the existing operation. There are the permits in place, there's community agreement in place. So it is about executing what we have built so far.
When you say attract capital, are we talking about attracting equity capital, or would there also be a portion of debt?
Predominantly debt, I would assume. I mean, a capex investment with an IRR of 40%, might be a syndicate financing between an off-taker, some equity perhaps, but predominantly, I believe you can finance this with a good portion of debt.
You would, yeah, and that depends on what you previously said about getting the costs under control this year, getting it profitable. That would also probably look better on on a debt sheet. What about exploration in the meanwhile? I mean, you're financing the build out with debt. Are you going to keep exploring in the meanwhile?
Absolutely. We're continuously exploring. mainly in our district. So that's the beauty of what we have, right? So we don't need to find new concessions. We don't need to claim new land. That was all done over the last few years. And the land package that we have has enormous upside potential, not only in narrow veins. And by the way, they're not that narrow, right? A meter 50, meter 80 sometimes. So it's fully mechanized, by the way, but also different deposits. We'll find disseminated gold on surface over large areas, which might turn out to be standalone projects. So we continuously do exploration with good results, but it's a huge district, right? And we're a modest company, so we can only do that much. But I'm absolutely confident that we will have, we will deliver great results. And by the way, as you mentioned before in your introduction, we had Triple Flag, a royalty holder, to put up more money. And one of the reasons they did that is because they came and visited us, looked at the project, looked at the district. They also secured let's say, a first right to invest further because they see the potential, right? This wasn't just topping up an existing asset that is like, let's get this out of the way, right? So you have some working capital, but more importantly is they wanted to get a foot in the door to at least from my opinion, is because they understand the actual potential of the district.
Do you, high up in the, I want to ask something, but otherwise I'm going to forget my previous question. So high up in the Andes, as you mentioned, 4,500 meters. How much are you paying per meter drilled?
That's a very good question. I think with lab results, so all in, including lab results, less than $200.
Less than $200?
Yes.
I would have
US.
expected it to be much higher.
US.
Yeah, of course.
Yeah.
Where are you asking?
That is a very good question. I do not know. We use several labs. I would have to get back to you on that.
Sure.
I mean, obviously, for the resource sort of stuff, I believe is SGS. Not entirely sure. Again, I would have to confirm. Obviously, for operation, we use different labs.
Yeah. Okay. But with the money that they put up for the royalty, cash in the bank right now would be about 1.5 million to 2 million left, somewhere in that region. Is that right?
1.5 million, sort of, yeah.
Yeah. Okay. How many meters are you going to be able to drill with that 1.5 million?
For 2024, I'm not entirely sure how many meters we have budgeted. But I would presume probably between 10 and 15,000 meters. That should be sort of like what we drill, right?
Okay. Sure.
There's
Go
yes.
ahead. I was just going to ask, when does drilling season start? Is it all I don't imagine it's year-round drilling, or is it?
Sort of. I mean, obviously we're drilling inside the mine underground. That's obviously all year round. And on surface, you can drill almost throughout the entire year. Right now is a bit of rain season, but not to the point that you couldn't drill at all. But to be honest, I'm not entirely sure how many drill rigs are running at the moment. Certainly underground, in particular the production drilling, right? And in terms of true exploration, that is something I believe we pick up in a few weeks again.
Okay, in a few weeks. And then I was asking where you're asking this because I was trying to figure out how long the turnaround times are going to be. So if you're drilling in a few weeks again, when do you think you're going to be expecting assays?
I don't think our turnaround times are that long. I would say perhaps 2 to 3 weeks, something like that for assays. But to be honest, I'm not that deep on the exploration side. So, being on the corporate development side, that's not necessarily the meetings that I join every week.
Right.
I can get that information over to you.
Sure. Okay. What about growing then further on? Because we can skip growing through exploration here, but let's talk about growing strategically. You tried doing a deal this year in the US. It fell through. What's the goal for you moving forward? Do you keep focusing on silver? Do you keep focusing on the Americas? Just what do you do from strategy wise?
Strategy wise, we have the firm belief that in the silver space, critical mass matters, right? So as a silver producer, for us, the number is roughly like 10 million ounces, something like that. So we wanted to become a 10 million ounce producer. So we know with the district that we have, we can get to 5-6 million ounces. So the question is, where do the other 4 million ounces come from, right? Now the silver space is fairly small, so sometimes you have to look at opportunities when you're not necessarily entirely prepared for it. And that was one of the cases that, in the beginning of the year, when we looked at the Euro silver mines in Colorado, it was an attractive asset. It came out of receivership, so there was an opportunity there. Unfortunately, our backer pulled out, as simple as that. So, but it wasn't the end of the world, right? So we lost the money for the due diligence, but at the end of the day, it would have been an asset that would have added another few million, and that goal remains. But again, 2024 is entirely on execution in the Nueva Recuperada district. So while we will continue to evaluate opportunities, it is not necessarily at the top of our list in terms of, we have to do that. And speaking, I mean, it's always hard to admit mistakes or faults, but I also believe that last year, one of the reasons our costs increased is because we were busy with many things amongst, M&A opportunities and those kind of things. So sometimes you lose a bit focus. We learned our lesson. We understood that. So for us right now, it's basically, back to basics, head down, get the job done. And if a great opportunity comes, obviously that includes financing and those kind of things. There might be mining assets with lots of money in the bank that are also interested in doing something together. Then it's something we will look at, right? As long as it creates value for our shareholders, we need to look at it, but we're not going to force it.
And that's the biggest question, right? What does value creation for shareholders really mean? What's the timeline and stuff like that? But so as far as I understand it right now, you want to get to that nameplate capacity first, get a well-oiled machine, if you will, and then go out and look for M&A. So, I mean, between now and 2026, you're not necessarily rushing M&A.
Not rushing. Again, you have to look, and again, the market needs to be ready for this, right? Because I mean, if you look at M&A, it always takes two sides, right? Unless you are, you have a war chest that is huge, and you can't just go out and buy whatever you want. But that's not necessarily how our industry functions, right? Putting assets together, then subsequently replacing management teams and so on. That needs to be a very well executed operation. And usually it takes an investor or shareholders to sign checks. So you need more than just one thing, right? You need the right timing. You need the stars to align for this to happen, right? I don't think it's something you can necessarily force. So if an opportunity comes around, we will look at it, right? But I don't think that the value for our shareholders is created by M&A today, not at all. I think the value for our shareholders will be created in getting 2-3 quarters, profitable quarters under our belt, showing that we can deliver. And then, when the markets eventually improve a little bit, commodity prices might improve, or the appetite of investors become bigger again, then things will change, and this will substantially create value.
Well, and again, that's sort of how I understood the entire strategy behind the company, is that you want to get cash flowing first, then use that cash flow to grow the thing organically without too much dilution. I mean, is that still the overarching strategy for the company?
Absolutely. I mean, if you look into the silver space, there's very few junior producers. Why is that? Because I believe they become seniors very fast, right? But I think there's two categories of junior mining companies. The one that just, build a resource or even recycle a resource, right? They're just hoping for better commodity prices. Something that wasn't feasible a few years ago might be feasible because the prices go up. And then there's companies, and they continuously raise money, right? Every 6 months, they need to raise money to pay for everything. And our idea is like, look, we consolidated a district with a permanent mill and a mine. Let's generate cash flow, right? Every dollar that we can produce, we don't have to raise. So we want to be able to pay our expenses ourselves and then build a good baseline for growth. And I still believe it is the right strategy, right?
Yeah. If you turn profitable this year, what happens to those profits? Keep them aside, safely tucked away, stacking them up for M&A, or, I mean, I don't know, are you planning a dividend or something else?
No, I think a dividend is currently not on the table. We need to, once we have our P&L improved, we need to fix our balance sheet. So reducing or repaying some of our debt. And then obviously keeping a good amount of cash in the bank, or respectively investing it where it yields the most money, which for us is exploration and continue to develop our asset, right?
Sure.
The highest, I mean, looking back over the last 2 or 3 years, the biggest return on investment internally was exploration, right?
Yeah. Yeah. Okay. Yeah, I think I've gone through most of it. Most of the stuff that I wanted to do, a little bit on exploration there more. But I suppose what's the next news release in terms of, I mean, what do you expect to announce next to the market?
In terms of news, we have upcoming, obviously, the financial results for last year. We're going to have some exploration results coming out. It will not be, let's say, we're not going to come out with the news every second week. It's going to be fairly standard because, as I said, our focus right now is to focus on the operation, get that done, get that sorted, and focus on that. So there will be a bit of update on financial, operational, and exploration, and that's about it.
Okay, good. Well, yeah, I'm all out of questions. Just one last thing here. I assume you talk to investors a lot here and there. What's a question that doesn't get asked too often, but you think should be asked more often?
It's a very good question. I mean, need to think about that for a moment. I guess most investors, like understandably so, have a fairly, I mean, they say they invest for the long run, but they want to see results fairly quickly, right? So generally speaking, sometimes the questions or what's lacking is the interest in, how are you going to do this over the next 2, 3, 4, 5, 6, 7 years, right? People ask you what's the next catalyst, right? But I mean, we didn't start this whole thing just to produce catalysts and flip this asset. So both the CEO, my business partner Jose Garcia, and myself, we're into this for the long run. And that's something very few people have interest in, right? How do you see this in 3, 5, or even 10 years, right? And that's our focus. We fundamentally believe that if we do the right thing and build a real company, we will exist in the long run.
Right. And I think that's communicating that to the market is probably a challenge, because you understand it and your CEO understands it, and geos understand what the mine can deliver and how much you're allowed to push it, as you don't want to sweat the asset, etc. But like, how do you communicate that to the market is probably a challenge in a an industry that really operates on a high pace drill results. And like, you can have amazing drill results, but if you're quiet for 6 months, the stock is going to come all the way back down, even though the asset has changed. So I suppose that's the challenge.
Absolutely. I mean, as a public company, we have to deliver quarterly results, but that doesn't mean we don't have a vision for the long run. Right?
Yeah. Yeah. Well, thank you, Sebastian. Again, I'm out of questions. I'm looking forward to hopefully continuing this discussion as you have developments. But thank you so much for sitting down with me.
Yeah, thank you much for taking the time. It was a pleasure.
All right, next up is Richard Williams. He's the president, CEO of Cornish Metals. It's an aspiring tin producer with an asset in the UK. Companies listed on the TSX Ventures Exchange as well as in London on the London Stock Exchange under the ticker symbol CUSN, where an average of about 100,000 shares trade each day. With a market cap of about 85 million Canadian dollars at the time of recording of this video and about 535 million shares outstanding, this is a 16-cent stock. There are also about 17 million stock options and 225 million warrants, which are exercisable at 45 cents Canadian, by the way. And then about 30% of the company is owned by management directors. 26% is owned by Vision Blue Resources, which, as far as I understand it, is a Mick Davis sort of investment vehicle. And then another 8.5% is owned by Barkersville, which is it's actually it was acquired by a Cisco development about 5 years ago, so technically it's a Cisco development today. As of the end of October last year, the company had $31.5 million in cash, over $2.5 million in marketable securities, $1 million in account receivables, and some prepaid expenses in there, resulting in, let's round it up to $35.5 million of current assets. Now that sat on the balance sheet against $2.5 million in account payables, again at the end of the third quarter, well, their third quarter, fiscal third quarter of 2023. As a mine developer, Cornish does not generate any revenue yet, and so its operating expenses for the first month of last year had to be financed, and they amounted to about $370,000 a month, which is give or take $4.5 million a year if we were to annualize that. That was for the fiscal 2023 again. As far as I understand it, the main focus for Cornish are their assets in Cornwall, which is in the southwest of England, with 3 separate permits in focus, that being the South Crofty, the Gwyneer, and the United Downs project. South Crofty is where it's at, so that's a flagship asset here. It's a well-known historic tin mine that first started producing it in 1592, which is around the last time I made my wife smile. But the mine operated as a copper mine at first, with tin as a byproduct. And it was really sort of a pillar of the community, if you will, that formed around the mine. It then stopped producing shortly, though, after I was born in 1998, due to low metal prices, but with the prices showing signs of recovery right now. And of course, the supply and demand fundamentals for tin being tipped towards the demand side, Cornish is now hoping they can make it work again. Tin mineralization here mostly occurs in tourmaline veins that go deep, up to a kilometer deep. So the plan is to go underground, mine that. Of course, they're going to have to dewater the mine first, build a processing facility, and start producing after that. And that process is well underway right now, with the production targeted for the end of 2026. So about, let's call it 3 years from now. Dewatering of the plant is also happening. They have their dewatering facility up and running since late last year. The company also recently published an updated MRE, which has resulted in 43,500 tons of tin at an average grade of 1.5% in the indicated category, which is an over 30% increase over the report from 2 years ago, and 35,500 tons are at 1.42% in the inferred category, which is also an increase about 15% over the same 2021 report. With the increase in South Crofty, it now falls within the top 5 highest grade tin deposits in the world. But the company believes they can grow even beyond that, as they're also, they're doing exploration on this target. And a 9,000 meter drill program started in September, with the main goal being to test the geometry and continuity of the newly discovered mineralized zones over there. The goal with this drill program was also to have, Crofty go through, South Crofty go through a feasibility study and have a mine plan before the end of 2024. And then, as I said, about 18 months after that, the mine is supposed or expected to be operational again. And although that's the focus here, as I mentioned, there are other zones around South Crofty, and Cornish even has a nickel exploration project, if I'm not mistaken, in the Northwestern Territories of Canada. And there's also another tin project in Alaska, but again, that's not going to be the focus for the company going forward, as far as I understand it, but we might touch upon it later on in the discussion. To start that discussion, though, I'm being told I'm supposed to shut up now and let the CEO do the talking. So, Richard, let's first of all, thank you for being here. Let's talk strategy. You say that you're some 36 months away from production. Is that the main goal to get into production, or would you prefer to be taken out before that happens?
No, being taken out has never really entered our thoughts. The objective here is to get South Property into production. We've put a team together that can achieve that. And I think when you look at the quality of the board of directors behind us, obviously a track record of running large multinational mining companies, very strong technical background. So I think we've got the manpower to do that.
Okay, but I mean, it's not on the table. But then I suppose if someone came along with an offer, you'd have to run it by the board and shareholders. But do you see that as I mean, is there any real probability in that happening?
Look, there's always a chance that it happens. Tin is a very volatile metal when it comes to price. We saw that during COVID, where there was increased demand for people to have more connectivity, better access on the internet, increased demand for tin, and we saw the tin price run up to $50,000 a ton. What we are aiming to achieve here is to put this project into production. We think it can be highly profitable, and when things are highly profitable, they become attractive acquisition targets. So if it happens, so be it. But right now, we're not focused on that.
At what price? What tin price would you call this asset highly profitable?
Oh, when we published a PEA, this is historic information now. In 2017, we were looking at a all-in sustaining cost of around $120 per ton. That was production, processing, G&A. At an average grade of around 1.5% tin, you're looking at over £30 per ton of tin, which would equate to current tin prices close to $400 a ton US. So high margin there.
Right. At these prices.
That's current prices.
Right. But then we'll obviously highly leverage to potential increases in the tin price, which is supposed where the pitch comes in. How come? Okay, so building an international tin producing company, starting with sort of organic cash flow growth from the South Crofty mine. How come nobody else did that? By the way, I mean the mine was closed about 25 years ago, as I mentioned, because of low tin prices. But ever since 2010, which is about almost 15 years now, we've had a volatile tin price, as you mentioned, but still hovering around or close to that level of about the levels that you mentioned that would make it highly profitable. So why didn't anybody try to get South Crofty into production before you got the idea?
Actually, they did. So in 2001, a company called Base Result acquired the project. And in 2007, they attracted investment through a company called Galena Asset Management, which was a subsidiary of the Trafigura Group. They invested a substantial amount, at least $15 million, putting in a new decline. They drilled about 30,000 meters of underground drilling from that decline. Then they attracted a group called Celeste Copper, a Toronto-based company that was backed by Liberty Metals out of Boston. And they spent a further $5-7 million to the point where they secured a new mine permit plus full planning permission to build the process plant. But this was around 2013, and we were in the depths of a really deep bear market. Celeste couldn't raise any more money to fund the project. I think it's fair to say that Galena were struggling on other investments elsewhere around the world, and so the whole asset was put into administration here in 2013, and we acquired it in 2016. So two of the three main permits that were needed to get South Crofty back up and running, the mine permit was granted in 2013, and the planning permission for the service facilities was granted in 2011. So they were really attractive assets for us, where we knew that you could permit a mine in the UK, and a big chunk of the work had already been done.
And now your timeline is again a mine plan in 2024, if I'm not mistaken. But the dewatering facility was delayed a couple of months, something like, I don't know, 6 months or among those lines. Do you think the mine plan will therefore also be delayed?
No, the plan, our estimates for dewatering the mine has always been 18 months. So we started dewatering in November, and then 18 months to obviously follow on, build the surface facilities, do the underground development, etc. So that still puts us at the back end of 2026. The delays that we suffered putting the water treatment plant really into operation were really a result of what happened post-COVID, Russia invasion of Ukraine, where we ran into this whole supply chain issues. Some of the materials that we were looking for were typically semiconductors, microprocessors. That was a delay on putting the motor control center into place. But now the plant's fully up and running, and it's running at capacity. So we're very pleased with the outcome.
So where I'm coming from with this is because of what you previously said about once we knew it's possible to license a mine basically to permit a mine in the UK. And it was kind of funny to me because I went to a conference last year in London and I had to leave early. So I had to fix my train tickets. And the bureaucracy was just astonishing, and I couldn't get it done. I had to drop the ticket and buy a new one, and so it's just sort of a reminder of bureaucracy in the UK. So maybe you can talk to me about that in terms of permits that you're gonna have to get between now and the end of 2026, as well as, well, yeah, just generally bureaucracy in the UK.
I think one of the areas we benefit here is that there is still an active mining industry in Cornwall. It's not underground and it's not metals mining, but it is open pit mining in the granites for feldspars. A company called Imerys out of France, China Clay. They're very large open pit operations. And so you've got a mineral planning authority that's part of Cornwall Council that understands mining. So when we submit permit applications, either to the mineral planning authority or to the environment agency, we've got a group of people that do have familiarity and understanding of the positive impacts that mining can have. And, as a result of that and kind of the collaborative approach that we take with both the local council and the environment agency, we've been successful in getting all the permits we require.
What kind of permits are we talking about here that you're going to have to get between now and the next 16-ish months?
Well, the only one we really needed to get when we acquired the project was the environmental permit to dewater the mine. And we work with the environment agency. I think what worked in our favor is that you've currently got untreated mine water discharging from a number of old mines in the region. And what we were proposing was to build a water treatment plant to dewater South Crofty. So in effect, we are removing a certain amount of water that was coming from South Crofty that was untreated. We are treating it, cleaning it up, and discharging a much larger volume of water that's now clean into the same environment. So we're actually improving the water quality in the Red River. And I think that environmental impact, plus the opportunity to create jobs in a region that would really benefit from the economic input here, has gained us a lot of support. And we're very open with the local community about what we're doing, why we're doing it, what the outcome is going to look like. And I think if you go online and look for any opposition to what we're doing, you won't find any. I think because of that open door approach that we've taken with the local authorities and community.
Is your the labor that you have, the workforce, is that mostly local people from Cornwall?
Yes, we have 57 people on staff right now down at site, all of whom live in Cornwall. Cornwall's famous not only for its mining industry, but also for a mining college called Camborne School of Mines, which has produced some of the world's best mining engineers, mine surveyors, mine geologists, mineral processors. And many of them still live in Cornwall. So there is a wealth of international experience available to us. Many people who have been through Camborne School of Mines work internationally now, but I think if the opportunity was there for them to come back and live and work here, many would take that.
It's a good point. Yeah, I actually didn't know that. What is, you say 57 people work or you have on staff right now. How do you expect that to progress as you get into production up until the time to when you're right before you're into production?
Well, obviously we're going to grow through the next phase. The next phase for us is to put in a team together to execute the mine build, planning for that, the engineering, completion of the feasibility study. We estimate that when we do get into production, we'll create in the order of 275 to 300 direct jobs at the mine, of which about a third of them would be underground. The balance would obviously be administrative and mechanical, electrical support on surface. And then beyond that, typically you're looking at anywhere in the order of 3 to 5 additional indirect jobs created on the supply chain side, hopefully again in the Cornwall, Southwest England region. So again, a good positive impact on the economy here.
And that's direct labor costs that are related to your production. What about G&A and labor? I mean, basically people in office. Do you expect to grow your office team as well?
Well, everybody's based down here. We don't have overhead costs. We don't have an office in London. We try to keep everything as tight as possible on site. Labor costs are lower in this part of the world, which is a positive. Our total G&A has got to be in the order of, I think you'd mentioned the number earlier,
Yeah,
$1.5 million a year.
What I noticed is that over the first half of 2023, director fees and salaries were quite a lot more than the first half of 2022. So there was a big bump there. What's that got to do?
Well, the first half of 2022, we had no money. So in May 2022, we secured the financing from Vision Blue Resources. We raised £40 million to move South Crofty forward. And, as a result of that, you want to put in place an incentive program that retains senior management, that incentivizes management to be successful, but also attract a board of directors that will have an impact and a positive outcome on the direction of the company.
Do you, so basically, where do you expect G&A to go? I mean, do you expect it to increase drastically or moderately, or do you just think it's going to stay the same?
At the senior level, I don't see it increasing drastically. I think on site here, we are looking at hiring additional people to help on the planning, engineering, and execution of the next stage of the project. So there is going to be an increase. We estimate another 20, 25 people that we need to hire over the next 12 months. So it is going to grow over the next 12 months, yes.
Right. Okay. Now, it's also interesting that you mentioned incentivizing insider ownership. As I said at the beginning, about 30%. That's not terribly high. Or is there plans to increase that between you and the other people in the C-suite?
Yes. I think you do that through both incentive stock options, and that's the main one for management, is to make sure that if the share price does well, shareholders do well. And we've set the stock options at the same price that Vision Blue invested in the company. So, we're all aligned, and we're all hoping for a positive outcome on the share price when we get the mine into production.
Right. Right. But what about just open market buying, though? I mean, looking at the share price, it's at about a 3-year low, $85 million in market cap. I can see you making the argument that it's undervalued. But if it is, why not buy in the open market?
Look, I can't speak for other people on the management team, but I've bought in private placements and on the market in the past, and I'll probably do so again, in the coming months. It's really when you have spare capital, you can invest it, and I'll be looking at that over the next few months myself.
Okay.
And then and to add to that, there are discussions going on amongst board members about what's an appropriate level for board members to hold as well.
What about your other large shareholders, Vision Blue, obviously the largest one? Talk to me about their involvement in the company, and do you have a feeling as they would, like, as you're raising money to build this thing, are they going to keep topping up their ownership, or do you expect them to dilute back?
Look, from my perspective, their investment and their intentions have always been to maintain their ownership level. Currently, it's around 26%. I've had no indication from them that they expect that to change. And if you look at the financing that we did, if we get the warrants exercised, that would require them to put in another £40 million. So they're fully committed to the project. They've got a very strong technical team, and so we have a very good collaborative technical committee that meets on a monthly basis, where we get input from their team, many of whom worked with McDavis in the past at Xstrata. So they've looked at projects internationally. When they invested in us and in South Crofty, obviously they had the opportunity to look at other tin projects around the world, and felt that this was the best opportunity that they saw. So, and it's also a reflection of what they see as the management team here and our ability to deliver. And it comes back to the question you asked earlier about risk and, how do you put a mine in the UK into production? And having spoken to, again, the local authorities, they feel very comfortable with the investment they've made.
And so if we can round it down to 25%, because it thinks easier for me. Do you expect them on further financing? You basically expect them to help you finance the mine development, but so basically a quarter of the cost they would have to cover if they want to stay at this ownership level, and you expect them to do that?
Of the equity side of things, yes.
Yeah. Okay. Good point. I mean, debt to equity, how do you think you're going to be financing that?
Look, I think that's part of the plan this year, is on delivery of the feasibility study. We're already in discussions with potential debt providers. Given that this would probably be a very modest sized mine build, when we published the PEA, again, you have to note that it is a historic document. We were looking at a capex of around $120 million US to put the mine into production back then, but that included dewatering the mine. We've already built the water treatment plant and we funded to do that. So, you may say that capex number has dropped, but we've gone through a period of inflation, so that push it back up again. But and we're not talking about $500 million here. An amount significantly less than that. And so I think it'll be a pretty attractive debt investment for debt providers, given the high grade nature and the long mining history that we can demonstrate at South Crofty. High grade projects, whatever metal they're in, are not easy to find these days. When you look at the operational history of South Crofty, after the tin price collapsed in 1985, almost all hard rock tin mines around the world closed down, but South Crofty kept operating for 13 years, purely because of the high grade and high value nature of the mineralization.
Right. It's a good point that you bring up the $120 million capex, because I inflation adjusted it through some websites. So I don't know how accurate it is, especially in mining space. We might have seen more, but it's saying that it's around 180 million today. How much of that let's just assume that the 120 in 2017 is 180 now in 2023. How much of that do you think is saved by you having the dewatering plant already in operation?
Look, I don't have numbers at the tip of my finger right now, but I would be surprised if it's over 150. And just the fact that we are trying to accelerate and get into production as quickly as possible, I think that's really what everybody wants to look for. The faster you get into production, the faster revenue, the faster the payback. Come back to your question about what kind of ratio. I think if we could secure 65-70% debt, that would be the target that we'd aim for.
Who would that come from? Do you have any ideas? Is it a UK bank? Do you go to Canada? What do you do?
I think, yes, we've got ideas. I'm not going to mention the names here, but there are a number of groups that could probably, this would be a single ticket investment for any of those groups. They're all familiar with the mining sector. They all understand invest in high grade underground operations. And I think there's a comfort level when you can look at a project that was in production until very recently. So we've got all of the production records, we've got all the pumping records, all the mineral processing records. We know what the recoveries were. So, it gives a lot of comfort to debt providers when you've got that kind of information, as opposed to a greenfields mine that's going into production for the first time.
Yeah. Well, 65 to 75% of 150. I wish I had friends who could put $100 million on a single ticket.
Me too.
That'd be nice. Yeah, that'd be nice. Well, Cisco Development's in there though. I'm not. I'm not alleging anything about them putting that much money, but it's just sort of on a different note. Cisco Development, also a large shareholder, now through their acquisition of Barkersville. What's your latest read on them? Do you expect them to keep topping up that ownership?
Look, I think Cisco Development Corp, their focus is being a gold company in North America. So, whether or not they participate in the future, I don't know. I'm not going to say one thing or the other, but their focus is not tin.
Yeah.
Does that mean they maintain or invest? We're not at the point yet where we're raising money, so I haven't had the discussion.
Well, I agree, which is obviously where that question is coming from, because they're focused on gold. What if they don't want to keep topping up? You could say, well, easily they get basically diluted out. Sure, that'd be the easy plan. What if they start selling? Do you have a plan to sort of, catch those shares basically so that they don't create an uncontrollable seller in the market?
Yeah, look, we've got a very long-standing relationship with the Cisco Group. They were the initial funder to get this whole company and this venture going. So they've been with us from day one. I know the management team at the Cisco Group, Sean Rosen, John Brzezinski, Bob Wares, very well for the last 20 years. So, I think we've got a good enough relationship that they will pick up the phone if there is a need for them to dispose or acquire anyone. And, we can have a conversation about that. And, we're always planning for events like that. So it wouldn't be something that would catch us off guard.
Right. Well, I appreciate that. That's already a first step. But still finding a willing buyer for those shares, 8%. I mean, it's $5-6 million at today's market cap. Where do you find it? Who buys those shares?
There's a lot of interest actually in the UK right now, not just from resource type investors, but also from generalist investors in the UK for what we're doing, because this is a UK project. A lot of regional development funds would look at what we're doing because of the impact we'd have on the local economy. Not just because it's a mining project, but because of the economic stimulus it would have for this area. So, we've hired a chap, Fauzi Hanano, before in the last quarter last year, and his role is to get out there and market to institutional investors, and he's been doing a fantastic job doing that. So if the opportunity did arise, we'd obviously speak to our brokers, pick up the phone and see if we could place a block of stock.
Yeah. Okay. Good point. Well, it seems to me like you have a plan for it, which is the most important thing, which I wanted to ask. And think about mentioning Fauzi, by the way, I wanted to ask about what his task is, so it's clear now. And then you have, as I said, current assets about $35.5 million. We'll give or take, probably changed a little bit since then. But what's the plan for that cash reserve? What do you do with it?
Well, the use of proceeds when we raised the money last year was obviously build a water treatment plant, which we've done, to dewater the mine, which is what we're doing, and to deliver a feasibility study, which is underway. And we expect the bulk of that feasibility study to be complete by the middle of this year. And then there's just some drilling that we need to do underground towards the end of next year that will get us over the line.
So how much money do you have left right now?
It's around £19 million.
19?
Yeah, which is still around 34, 35 Canadian.
Yeah, something like that. Okay, so most of the money, basically. Where'd you keep that money, by the way? Not under your mattress, I assume. So it was a savings account, treasury, something else?
Well, we've invested in the money market. So GICs, higher interest yielding accounts, that different chunks in different places with longer investment periods. So we maximize the interest that we can gain on different chunks as and when we need it.
Okay. Yeah, fair point. I mean, is a bunch of high savings account, just other money market options to put your money in today to make the best of it. Okay, so we talked about that. I was going to ask you about the IRR, if you were going to be able to keep it above 20%, but then you said we talked about inflation, so that might be a bit redundant here. What about grade? I believe grade, the 2016 resource estimate had higher grades than the last one you did. Still higher grade. I mean, I'm not alleging it around those lines, but do you expect grades to stay at this level as you move forward on the feasibility studies?
Yes. So we've added a couple of new areas into the mineral resource estimate. which historically were known to be lower grade anyway. So we were expecting the grade to come down a little bit. I think the focus for us going forward are the main principle for resource expansion anyway within the mine would be the Roskia, ABD, Loads, number 4, number 8, Providence. These are all much higher grade areas historically, and that's where we would expect to look for additional resources once we get underground. From a, what I really like about South Crofty, when you look across the mine in the last 100 years of mining, the grades have been very consistent throughout the mine life. So, typically it's 1.3 to 1.5% tin. In some areas like the Roskia area, as high as 2%. And more importantly, the nature of the mineralization is such that we get exceptionally high recoveries when you compare it to other tin deposits. Typically, tin occurs in two forms. The really attractive one is cassiterite, which is tin oxide. What we don't want is stannite, which is a tin sulfide. That's more refractory, and all of the ore here is cassiterite, so that's a big plus. And then on top of that, the grain size of the mineralization itself is very coarse. We've recently completed the first phase of metallurgical test work for the feasibility study, which showed that a big percentage of the ore is over 150 microns, which is very, very coarse for tin mineralization. And you can correlate that back to when the mine was in production. They were recovering 70% of all the tin mined just through straightforward gravity processes. So mineralogically, metallurgically, it's very straightforward. And one of the big advances that I think will help the mine be more profitable is the advent of ore sorting technology. So we've run tests through Tomra. They're all sorting XRT ore sorters, and found that we can reject in excess of 50% of the material mined, and without losing, well, it's less than 3% of the ore lost. So very positive outcome for that. So, the knock-on from that is that we need a smaller mill, slower power cost, and lower capex to build it.
Back in the day, I believe they were using gravity for the first time, 70% is, and then flotation, if I'm not mistaken, to get to above that, to around 90%. I mean, I assume you still think you can hit that 90% and higher, right?
Yeah. All of the results that we get in from all the work we're doing in the feasibility study really just corroborates what we knew from historic mining activity.
Does the size of the grain, I'm arm waving here, I have no idea what I'm talking about, but I'm just thinking, does the size of the grain have anything to do with why the mine got flooded in the first place?
No. So basically, a potted history of the mine. So the tin price collapsed in 1985. That was a function of new tin mineralization coming into the market from new mines in Brazil and Malaysia. And at that time, there was an organization called the International Tin Council, which was a bit of a cartel. They tried to control the tin market, maintain a stable price that was good for the producers and also good for the buyers. And this new tin that came onto the market flooded the market. Tin price collapsed. The cartel went bust, and a lot of tin mines closed down. Roll the clock forward into 2002, and the big watershed moment for tin was when the EU passed legislation outlawing the use of lead solder, and the only replacement was tin. So all of a sudden you had this leap in demand from 200,000 tons of tin per year to 350,000 tons of tin per year from 2002-3 onwards. And that's really absorbed all of the excess supply that was in the market. And if you look at the International Tin Association today, they're projecting tin demand to grow between now and 2030 to in excess of 500,000 tons of tin per year. And that's really a function of electrification of economies around the world, the growth in demand for semiconductors, microprocessors, electric vehicles, anything to do with electronics requires more tin. And that's the big driver, I think, going forward, the same as any other technology metal.
Right. But when did that mine get flooded in the first place? And I'm thinking about it geologically. And why I'm thinking about it, I can tell you that, maybe you can answer it. I'm thinking about what the risk is of that happening again, basically. That's why I'm asking.
All mines have water inflow through fractures in the rock. Some mines are what you'd consider wet, other ones are relatively dry. South Crofty is, in fact, a relatively dry mine. If you compare it to, there was another mine about 15 kilometers east of here called Wheel Jane, which was operated by Rio Tinto in the late 80s, early 90s. That was a much smaller footprint of a mine compared to South Crofty, and they had to pump 30,000 cubic meters of water a day to keep that mine dry. Whereas at South Crofty, the average pump in was about 6,500 cubic meters a day. So, 20% of what was happening at Wheel Jane. And then if you cross to Ireland, there are some lead zinc mines in Ireland that need to pump over 100,000 cubic meters of water a day. So when the mine closed in 1998, obviously the pumps were turned off and the mine slowly filled up with water, both from water coming out of fractures in the rock and also rainfall on surface, which made its way into the old shafts and down into the mine.
Okay. But you basically, the way you manage that is having that water pumping facility there, and then I assume you're going to keep using it during operations, or how does that work?
Yeah, so right now, to dewater the mine, we are pumping 25,000 cubic meters of water a day, treating that and then discharging it into the local river. Once we get into production, obviously the mine is dewatered at that point, so we've got 3 parallel streams for water treatment, and we will shut 2 of those streams down, so we'll only need 1. Each stream is capable of doing 8,500 cubic meters per day of water treatment, so that's more than enough if we look at the historic pumping requirements when the mine was in operation. So, at steady state mining production, we're looking at an average of 6,500 cubic meters a day.
Okay. Essentially what you're saying is manageable, basically. Yeah. Good. What else could go wrong with a lot with an underground mine? But what else is specifically on this thing that keeps you up at night?
I think it's fair to say that most projects right now is really finance risk. Certainly when you look at something like South Crofty, because it's got that proven history. You can tick the box when it comes to recoveries, geology. We know what the geotechnics are like. The ground competency underground. You're effectively mining quartz veins in granite. Granite is very competent. In many places of the mine, they actually didn't use any ground support. And you can go to old workings 200 yards away from here, which are only 30 meters below surface, and they were mined 250 years ago, and they haven't moved an inch. So, ground stability is very good. The metallurgy, we keep proving with all the work we're doing on feasibility study work that everything was as it was. The mineralization has not changed. It's really, I think, market driven. Can we raise the money to put the mine back into production?
Continuity is also not an issue, I don't assume, with these type of tourmaline vein deposits.
It's what's amazing about Cornwall in general, and South Crofty in particular, is the continuity of the structures that host the mineralization. You can trace them for kilometers. We have a really interesting 3D model on the front page of our website, which is a 3D view of the entire mine, and you can look at that, and you can look at how extensive laterally and vertically some of the main mineralized structures were within the mine itself. Now, there are, like most high-grade vein-hosted gold systems, you do have chutes with higher-grade mineralization. So there are zones with high grade and zones with less grade. And, you only figure that out once you get underground, do more drilling, but the continuity of the structures themselves are incredible.
Well, when I looked online before having this conversation, Richard, I did a bit of social monitoring, if you want to call it that. Well, what are people saying about this company? And basically the consensus was that you're not getting the full value for South Crofty, let alone all the other assets that you have, which are way earlier stage, obviously. So maybe not worth too much, but worth something. And so that got me thinking, why even keep them? The market is not giving you any value for them right now. Like, could they maybe be a source of capital in a sale or an option or something else?
Yep, very much so. We are talking to various groups about exactly that. We don't have the bandwidth or the capacity to go and work on a project in North America. Just the list of the assets we do have, the Nickel King project, it's an open pitable nickel sulfide project that was discovered in advanced 2007 to 2010. It's got a resource of about 11 million tons indicated, another 33 million tons inferred of around 0.4% nickel plus some cobalt in there and a bit of copper. Potential to be double that size. So obviously with nickel being on Canada's critical minerals list, there's been some interest in that project. So we are talking to people about that. Similarly, we own the Sleetat tin, tungsten, silver project in Alaska. It's one of the, if the not best known tin deposit in North America. There is no tin production in North America, so I think there is interest in that one as well. And then we also own a 4% NSR royalty on the Mactung tungsten project in Northwest Territories, Yukon, which is, I think, the biggest, highest grade undeveloped tungsten project in the world right now, and that's been acquired last year by, what are they called?
Fireweed.
Fireweed Metals, that's right, yes. So, it's a strategic metal. Obviously, it's got its military applications, and certainly the US and NATO and groups like that are very keen to have their own secure supply of some of the materials that they need for these military applications. And I think Mactung would fit that. So we do have a number of assets that we think have a lot more value than currently being signed, and we will look to monetize them.
Well, I agree. I mean, every asset out there has some type of a value. Mactung was kind of an obvious thing for Fireweed, sure. But then I'm thinking, who else? I mean, there's the tin companies that are out there. You can basically count them on one hand. One of the, the biggest one is Focus, where they're focused. It doesn't seem like they want to go out of there because they have a good thing going. Maybe they do. What do I know? But I mean, who buys this if it's not one of them?
Are you talking about Sleetat?
No, I'm just who buys these? I should have said like who buys one of those assets?
Well, I think the nickel project. There's a lot of companies looking for nickel sulfate, so there's a lot of interest in that, and we saw that come up last year at PDAC. We weren't even advertising the fact that we own Nickel King, and probably the most interest we had at the booth last year was in Nickel King. So people are aware of it. I think for Mactung, it's a royalty. And so any royalty company should be interested in looking at royalties that are available, whether it be in gold, silver, copper, lead, zinc. It's still a royalty. It is a world-class deposit that potentially has a very long life ahead. And I think that's what all royalty companies are looking for. So, if you're agnostic to the commodity, then you should look at Mactung. And then when you look at Sleetat, it's an earlier stage project. There are exploration companies. It's earlier stage. It needs a bit more work. So there's a lot of companies at that kind of stage who can look to raise money and go do some work in Alaska this coming summer and hopefully add value to that.
Do you want to do a deal of those sorts first before you go underground and start exploring again, or is that just on the plan for this year?
Look, I don't think we can afford to hold up the project here just to wait to get a deal done somewhere else. That's not going to.
Okay. So what is sort of a realistic timeline as to when you want to get underground, start drilling again?
Well, the dewatering is going very well right now. I think, we're about 200 meters below surface already. So, as soon as we can get in, we'll start drilling. I don't know if that'll be by the middle of this year, but as soon as we get there, we'll make that announcement.
Okay. So it's time, but also operationally dependent and also capital dependent. I mean, there's a bunch of variables here.
There are, but, as I said, there's a lot of interest in what we're doing. I think from an equity side, some very good interest. So raising money and certainly having the support of Vision Blue, I think I don't foresee any short-term capital crises. Okay.
Well, what about other exploration? Because I know in the past you've mentioned that you have a bunch more ground. There are places that you could go and explore. They're not necessarily underground. Are you planning any of that?
We're actually drilling right now at what we call the wide formation. I think you mentioned it earlier.
Yeah.
We've got 2 drill rigs testing a 2.5 kilometer strike length of a brand new structure. Visually, it's there in every hole we've drilled so far, so it looks like it's got at least a 2-kilometer strike to it. It sits directly beneath another mining district called the Great Flatlode, which was mined over about a 5-kilometer distance. So, again, it comes back to the continuity of some of these big structures. The structures are there. What we're looking for now are the high-grade shoots within it. And if we find them, then we can start building out some resource tons on them. And it's so close to South Crofty, we could see that coming into the mine plan here if we have success there. And so the way we are designing the process plant is to make sure that we can expand it on the current footprint from, up to maybe 800,000 tons a year without expanding the footprint of the process plant itself.
And so if you find something, that's a big if, of course, but if you find something, you wouldn't have to redo any feasibility studies or something like that.
No, that's, obviously you look at costing, the cost to get out there and the cost to develop it, but it could come within 500 to 700 meters of the existing decline access that we've got at South Crofty, so it wouldn't take too much to turn the decline around, put a new access tunnel out to that area and start developing it. That wouldn't be a huge capital cost.
Sure. But you said you're still drilling it, and you said 2 drill rigs. That was supposed to be 9,000 meters, right, of drilling?
Yeah.
When's that going to be? I thought it would have been done by now. When's that going to be done?
No, we can only drill a single shift here because it is in a residential area, so you can't drill at night time. So it does take a little bit longer. We hope to get some initial results out over the next month from the first few holes, and we hope to complete the program by April this year.
Okay. So how many holes are we talking about total?
14, 15.
Okay. 14, 15 holes. Okay, good.
So, basically the concept for the first pass here is to demonstrate continuity over a 2.5 kilometer strike length and 500 meter down dip. So you end up with a slab that, if it's a couple of meters wide, geological tonnage potential somewhere in the 6 to 10 million ton range. And then
that'll be, so you're assuming basically the same grade as we have at South Crofty.
I'm not assuming anything right now grade wise. I'm just telling you what the tonnage potential is. When we get the assays back, we'll understand what the grades look like.
Right, but I assumed you were assuming the grade because you're talking about the tonnage in a way that, like, for that to be as significant South Crofty, you would, too early stage to talk about it. I'll let you be.
Well, we did publish the first hole that we drilled that was published for a year ago, actually. That was just a test of the thesis that we had, that there was a structure sitting beneath the Great Flatlode, and that came back with 3 meters of 1% tin. So it's within the realms of what we've got on the resource here at South Crofty.
Yeah, fair enough. Fair point. Okay, what else? I think I'm getting a fair understanding of what's going on. You talk to people who are many times more smarter than me on a daily basis. What's a good question to ask you? Like, what's a question that not many people ask you, but you think is a good question to be asked?
Oh, well, there's a lot of knowledgeable people down here. They all know South Crofty mine inside out. So I think there's a lot of misperceptions, which I think is the biggest thing that I would like to address. Some people have this idea that because we dewater in the mine, we're actually we dewater in a very big, large area within Cornwall, but the rocks themselves are impermeable. There's no porosity. It's not like you're dealing with a sandstone or an aquifer or anything. The water that's in the mine is really the water that's confined to the old mine workings, and there is no connectivity to other mines in the area. So we're just dewatering South Crofty. And well, how do we know that? Well, when the mine was in operation, if you can imagine a ball of underground workings, and sitting over the top of it was all these old copper mines. When the tin mine was in production, all of the old copper mines remained flooded for the last 90 years. So they are not connected from the copper mine to the tin mine. So we're very confident of that. Ground conditions are very good. Yeah, you know what? I think we've run through the main points here. There's not really much to add there.
Yeah. Well, I think so. I think it was a good conversation. Yeah, I don't have anything else to ask. So well, thank you so much for sitting down with me. I hope I can keep following up with you as you have grades and other stuff to talk about. So yeah, thanks again for sitting down with me.
Appreciate it. Thank you.
All right, next up is Stephen Stewart, CEO of QC Copper and Gold, well, you guessed it, a copper and gold development company developing Canada's highest grade open pit copper and gold deposit in Quebec. Company is listed on a TSX Ventures exchange under the ticker symbol QCCU, where an average of about 250,000 shares trade each day, with a 52-week high of 19 cents and a 52-week low of 11 cents. Since the recent news, the stock is up over 50%, and with about 175 million shares outstanding and a $30 million market cap today, this is a 17-cent stock. I'm not doing a full company overview here because Stephen has told us about QC at least half a dozen times in the past. But the gist of it is, well, what I said at the beginning, the highest grade open pit copper deposit in Canada, and more specifically, that's in the Chippewa district of Quebec, hence the name. The reason why Stephen is here today, though, is because his stock again went up about 50% over the last couple of days as QC released an updated MRE showing a 2.24 billion pound deposit, and that's copper equivalent. In a model pit, that's probably on your screen right now. That the yellow stuff that you're going to be that you're seeing, that's the in-pit resources. The M&I category, that's where most of the tonnage is. It shows grades of 0.93% and 0.59% in the inferred category. And then out of pit, that's the blue on the image that you're seeing. The grades are even higher, up to 1.4% in the measured and indicated category and 1.1% in the inferred category. Again, those are copper equivalent grades, but almost 85% of the resource is actually copper, with the rest being byproduct credits in the form of gold mostly, but also some silver as of now as well. But also the prices that are used for the calculation of the EQ grade are reasonable, so I guess I'll allow it. What's more interesting, at least to me here, though, is the starter pit, which has grown by about 40% since the 2021 MRE, and we're talking about 456 million pounds of contained copper. So that's almost 20 million tons at over 1% copper equivalent grades. So this results in well, basically an almost immediate cash flow after the starter pit has been built, and potentially quicker payback period for the whole thing. Of course, all in the realm of speculation for now, since there is no PEA as of yet. This is just an MRE. But so this starter pit, which in my opinion was ignored by many of, by the looks of the online chatter, it was ignored by a lot of people. And to me, it's especially interesting because one of the main issues raised against the Opimiska project has been in the past, has been the presence of a small mining town. And when I say small, it is actually small. There's about 1,000 to 1,500 people living there now. And that's down to that, about half of the people who lived there back in the 60s and the 70s are no longer there, because this town was built for the Opimiska underground mine in the first place. That was in the 50s. But so if the open pit here would eventually expand, portion of the town will be influenced, right? But not immediately, because this starter pit sits outside of the town, again, resulting in less capex at the front end, then good cash flow, and then the rest of the capex would come, as opposed to all the capex being weighted in the front end of the ramp up curve, as it typically is with open pit deposits. So yeah, that's why I like the starter pit, and I wanted to mention it here at the beginning. And in a nutshell, that's the overview of the numbers of what was released this week, and there's a lot more work to be done here as far as I understand it. And then eventually the ultimate goal for this asset would be to end up in the hands of a major who's capable of building these open pit mines, or not. But Stephen, that's what we're going to be talking about here today. And I want to start it maybe at a weird place, because in the new presentation that you have up on the website, and also in previous discussions you and I have had, you'd often say that the quality of the data that makes up this new updated MRE is better. And I kind of understand what you mean by all that. But again, it slowed you down, and it probably costed a bit more. So what does that really mean in tangible terms? Like, how do I benefit from that as an investor?
Well, thanks, Antonio. Before I get to your question, I got to say, I listened to a lot of your interviews, and you always do such a good job at introducing the companies. I don't know if I have too much more to add. But to answer your question about quality, I think, as I said, the quality aspect is the most important thing. As the old adage is garbage in and garbage out. And that is exactly true with resources. And resources stem from databases. It's nothing more than the aggregation of a bunch of data, and you stitch it together, and from there flows the interpretation of the geology. So if you don't get the data right, the drill inputs, the geophysics, and meld everything together, then everything else is wrong. And we have seen time and time again in this industry, my contemporaries and me, I've got it wrong in the past before. I mean, this is as much of an art as it is science. It's a blend of both. Hence, its risk. Mother Nature is very risky, but our industry has failed many times because of poor data inputs. Which really often leads to, when you get into the mine face, or the vein's not where you thought it was. Okay, so I think that's the importance of the quality, and part of this project, it's blessing, and it is a blessing, but also there was a curse. I don't want to be too negative about it, but it was a curse in the sense that it's so much data, it takes so much time to weed through. We've got nearly a million meters of drilling, 300,000 assays, etc., done through various eras. And with that comes, while it was always done, besides us, it was always effectively done by one operator. There's just different regimes and different processes, and so we just had to get to the bottom of all of it, ultimately to snap together an interpretation of the geology that is as accurate as possible. When we did our resource our maiden resource in 2021, it was done, I don't say on a shoestring, but certainly not to the level of detail that it was done now, because while we were doing it, keep in mind, we were a $3, $4, $5 million company when we released that report. We came out of nowhere, right? So and nobody cared about copper at the time. We had certainly a macro view on the price of copper, and saw this project, which Charles, our vice president of exploration, had a vision and knew this project going back to the 80s, because he had worked with the vendors of the project. So he had a view on it. We had a view on the price of copper, but we just had to stitch it together. Anyway, the point is, we didn't do it ourselves. Like 99% of the other juniors there, they handed the keys over to a independent, qualified person. There's many people. Look at any 43101. Those are the consultants that write the 43101. They're consultants. A lot of good groups out there, some less than great groups out there. But the point is, when we realized that this is going to be a mine, okay, that's a forward-looking statement, you can qualify that, but that's what we believe. And we're not just blowing smoke, because we know more about this asset than anybody, and we see its potential. But when we came to that conclusion, we said, okay, well, we need to build a totally defensible database from where not only this could be effectively be built, but like the pre-feasibility, the PEA is next step, and the pre-feasibility and the feasibility needs to flow from this if we're going to get it right. We don't want to fix mistakes in 2 years. We want to do it right now. We also want, we've had a lot of people, when I say people, I mean strategics, people who build and operate mines, express interest over the years, in particular as of late, as we came and are now at the release of the updated resource. They want to see what we have, and we knew that was coming. So we don't want to show a multi-billion-dollar company a typical junior 43101 report and the database. We want to show them something that I think is on par with anything that Barrick, Kinross, Teck can produce. So that's a level of quality, I believe, that we have delivered. It took us, as you say, it took us longer than anticipated. We were delayed. I think anybody that follows us knows that. We were delayed. We tried to guide as forthright as possible, but and manage those expectations. But at the end of the day, we were late, but for good reason, because good things take time. And while I do think we delivered quantitative improvements in the grade more than anything, the quality is the most valuable thing in my mind. And why that's important to you? Well, it's not important to you if you're flipping QC copper from 12 cents to 17 cents. No, but that's not how we operate. I operate as an owner, a long-term shareholder, and the CEO and the chairman of this company, and I have to take a long-term view on what is best for the company, not what is best for the stock market today. And to deliver a top-notch quality report was the mandate, and we did that.
Right. So if, as far as I understand it, you operate from the standpoint of you want to change that picture that's behind you with Optimiska eventually, as far as I understand it.
Yeah, well, the picture behind me there, that's Yanacocha. You know, a beautiful satellite image that's been colored in, and nothing would excite me more than to deliver that picture to Charles Baudry when this thing goes into production.
Strip ratio's got to be there for you to go into production, and I didn't see much about that right now, which is not surprising since this is an updated MRE only. But it's been raised as a point of concern for the project before. I've talked to Charles about it. We've discussed it at length. I'll direct people to those videos if they want to know more about it. But how do you look at strip ratio now that the grade has been increased and the starter pit has grown?
Well, the strip ratio, yeah, you're right. On mineral resource estimates, you're not allowed to talk about strip ratio. That's not something that is disclosed. But strip ratio obviously is important when you're building an open pit mine. I'll reference when you have high grade, especially grade that goes down, your strip ratio can go up. So strip ratio is always something that we're going to be cognizant on. That's something that we're going to be focused on in our geotechnical drilling, so we can get the steepest pit slopes we can. It's, you know, there are, in terms of growth, and we can talk about growth, there are areas that we're going to increase in the in pit, you know, areas that we discovered throughout the 55,000 thereabout meters we drilled in the last 2 years. So yeah, our strip ratio is something that we always have to pay attention to. It's very important in an open pit. We think, you know, our grade will supersede anything. You look at the cutoff grade. We lowered the cutoff grade this year to 0.15. 2 years ago, it was 0.2. That was a decision made by the independent QP, not by us. And I think all the inputs, just for the record, all the inputs, including cutoff grade, metal prices, that was all done by us. That was suggested by the independent QP, and we didn't fight. We could have fight. We can influence, but we didn't. We just accepted it because we thought they were reasonable. And but if you look at, I guess my point was, our average grade, even our average grade, what in pit, if you do copper equivalent, is almost 6 times, or in fact, maybe even more than 6 times the cutoff grade. So that is substantive, and I think it's high grades like that, high margins like that, that can sustain a higher strip ratio than something that's scooping the top off a mountain.
Mm-hmm. And then eventually, with the PEA, we're gonna know the exact numbers on the PE ratio. But again, targeted a couple of times before, and with this increased grade, it changes things. Do you by the way have something in the dry tailings? Is there anything left that you can produce and sell for any money?
We haven't evaluated that. In the second half of 2023, we purchased all of the tailings. We didn't own it before, but we got it from a company looking to exit, and there we were. We bought it for a steal. Frankly, it was more a land grab than anything else, because our original land package was pretty tight to the area of the open pit as defined on the western boundary. So we extended our western position quite substantially, and with that came the tailings. Now, the tailings in many places, like, again, I emphasize, we've done no work on the tailings. But you can see in the tailings, which are sort of dry stacked in little heaps or mountains or hills, whatever you want to call it, they're stained green. So there's copper there. When you look at the average, or excuse me, the cutoff grade of the underground mine was 1.5%. So theoretically, there's a whole bunch of 1.5% or 1.49% material and lesser sitting there in those tailings. So down the road, I mean, it's not our focus. I think on the marginal basis, we're best off drilling areas underground, expanding the pit, and then of course drilling on the Cook and the Robitaille. That's better bang for our buck. But there's no question, the thought has crossed our minds that when we're a little more advanced, we will take a look at those tailings. The thing about tailings is it's very, very difficult to get an accurate assessment of what they are. I mean, you can look at the aggregate and you can sort of make assumptions, but the deposition of the tailings is often not uniform and could have been shifted around. So, you know, just because you drill something doesn't mean it's continuous over there. So it's kind of unreliable, but there is certainly an opportunity to evaluate that down the road.
Mm. Is that chronologically how it's going to go down? You drilling the 2 other deposits, adding them to an MRE, or do you want to do it simultaneously as you're drilling for the PEA?
Well, we're actually going to be starting drilling in a couple weeks, and we'll have more details out on that shortly. But just broadly speak, and then beyond that, our plans for 2024, more detailed plans are coming out very shortly. That will include, of course, developing the open pit as it's defined in this resource in terms of engineering and economics and moving that forward towards the PEA. We've done a lot of the inputs to the PEA, but there's still more work to do. But PEA is a desktop study, and it's a first pass at the economics, but also there will be lots of engineering considerations in terms of our mine plan, because we do have a town to consider and the impacts, and there's pros and cons of mining the whole ore body as is versus, you know, certain other mine plans that may or may not be as or less impactful towards the town. We've always said we're going to impact the town. We think the impacts are on the net aggregate basis are going to be extremely positive, but you know, like anything, there's trade-offs. So that's something that we're going to be working on. Certainly the engineering aspects, we're going to be working with the town. I'll be up there in about 2 weeks presenting this resource to the community and getting their feedback. They're excited. It's about managing expectations. They want to see economic and employment opportunities there. That's the most common question is jobs, you know, and development. I think it's also an opportunity for the townspeople to keep their children, right? I mean, you know, we hear a lot about demographics and small towns in the north that don't have a lot of economic opportunity. The children tend to go south to Quebec City, Montreal, Toronto, whatever. So the town on the whole is quite excited about it, but we don't take that for granted. We're very proactive on our communications. Let's just put it that way, to inform them, listen, and manage expectations. So to circle back, the PEA and the development of a mine plan is our priority, because that is where the bulk of the value is. Certainly right now, that's where all the value is defined in this resource. But I think in parallel, we are absolutely going to be working on the Cook and the Robitaille, which is mines 3 and 4. So as just to sort of clarify, the Opemiskil, when it was operated by Falconbridge from the late 40s, early 50s to when it shut down in 1991, had 4 separate underground high-grade vein system mines. They're all very proximate to each other. The first 2 mines, which were called Springer and Perry, that is where our open pit is right now. So that is where all of the talk is and where all of the current resources are defined. There is, again, the 3rd and the 4th mine is the Robitaille and the Cook, about 2 kilometers away. So they're a little further away. They will not form part of this quote-unquote super pit, which is Springer and Perry, but they will be satellite deposits. That's our anticipation. We have a good deal of data on them. Just like we had a tremendous amount of data on Springer and Perry, we have a lot of data on those as operating mines. And so we have a general understanding of what they are and what they could be, but they have not been drilled out systematically by us in the concept of drilling out an open pit deposit. So that is on the agenda for 2024. And we do believe that that is going to add substantive tons and ultimately pounds in the ground and potentially ounces in the ground. Because I will also note that Cook, again, one of those in the 3rd and 4th mine, was a gold mine, right? Whereas Robitaille, Springer, and Perry were copper mines with gold and silver credits. Cook is an outlier because it is a gold mine with a copper credit. Quite the inverse in terms of ratio, which is unique, and it's we can't say definitively why, but it's on the other side of the fault. And so we think that might be a reasonable explanation as to why the copper gold ratio is in the inverse. But nonetheless, there's definitely what would be economic resource there to add to our existing open pit. Then again, we also own the Roger project, or we own 50% of the Roger project. The other 50% is owned by the Quebec government. That is further away, so it's not a priority for us when you look at things in terms of NPV and IRR. That would have to be super high grade to supersede any ton going to the mill, given the transportation costs, etc. That said, it is on the rail. But I think, over there is a whole separate, different little camp, even though we're very proximate to each other. That is more there's more a gold system over there. So I don't want to get too far ahead of us, but we have lots of exploration potential, certainly some that we deem as lower risk, being Cook and Robitaille, And then, of course, also I have kept the lid on Charles and the team's call it grassroots exploration activities, because we have been very careful about allocating our capital towards the low-hanging fruit, which is defining this pit. But the ground that we are in, and we have a very, very large land package, I think 27,000 hectares, is very, very fertile, because between us and the Chibougamau district, there's 20 historic mines there, and other deposits, and those are former operating mines. So very fertile ground, plus a whole host of other deposits that have never been mined. So this is a district. We do have a vision for the district, and we view the Opemiska as the anchor. Nothing is even close. Nothing comes close in terms of its size and value, and my humble, biased opinion. But it does have the opportunity to be the anchor, build a mill, and then just that mill could be fed for generations out of that district. That's the opportunity, but it all starts with Opemiska.
And I guess it'd probably be too early now to ask you how the drilling is going to be split in terms of percentages, how much goes on which pit. I suppose we'll see that. What would you say, in a couple of weeks or sooner?
Yeah, we're gonna start drilling. It's not going to be the mother lode drill program, if you will. It's going to be a sort of a modest testing of a couple sites, but that they will be on the Cook and the Robitaille portions. We'll have a release out in the not too distant future. We're talking a week or two max, detailing that. But that won't be the mother lode drill program. But we're going to get out there and get started.
Sure. Where I'm coming from with this is because there was a sort of a disclaimer in the news release saying that some of the historical data, you don't have that core because it's no longer present, and so the certainty of the data is not at as high of a level as it would have been if you had drilled it yourself. And I was thinking whether that means that you're going to have to re-drill some of those holes in the meanwhile.
No, we won't re-drill anything per se. But yeah, as we have said, and we do have a risks slide on our presentations. I encourage everybody to go look at risks from, yes, this is historic information, to inflation, to geotechnical drilling, to the town. These are things that we need to address, problems that need to be solved. We believe all of them are solvable. All of the core, I shouldn't say all, but I think the vast majority of the Falconbridge core was thrown through the mill, right? They were operators. And so yeah, we don't have access to most of the historic core. But this is the sort of saving grace, is that Falconbridge, they were mining it. And so and they kept, A, they were very good operators. B, they kept excellent logs, which we have digitized, not just the assay data, but the logs themselves, talking about the lithology. So we have the geology there. So it's not just capturing the zones based on grade, it's capturing the zones and understanding them based on the lithology and the changing of the rocks. That's very important. So that again speaks to the level of quality that this database that we delivered has. The first iteration didn't have the description of the lithologies, which is critical and laborious, very much so. So yeah, we have good logs, and again, they were not junior miners. They were operators, meaning that if their drill data and logs were incorrect, well, they were mining left when they should have mined right, so to speak. So they had, they would be certainly incented to have accurate records, and by and large, we found that they did. And I mean, so we have a model, obviously, that exists in 3D that is much like the image that we've presented in our presentation. And when we drill, we hit where we think we're going to hit. So that's a very simplistic rationale or explanation or justification that we have confidence in the data, but time and time again, we hit what we think we're going to hit where we expect it to be.
That's a good way of putting it. What is where I'm coming from with this? Because I'm thinking, how far up the economics process do you think you're going to have to take this again? This drilling is going to be part of you moving towards a PEA. Do you think you have to take it much farther than a PEA for a major to come in and say, hey, I want to have this?
Well, I don't have the answer. I'd be speculating. So I don't predict the future too well. Although that I can say with great conviction that large mining companies are going to want this asset because it is the highest grade copper open pit deposit in Canada. It's a rare jewel. Not only is it high grade open pit in Canada, it's in Canada, which I think on the geopolitical front is going to become more and more important. And not only is it in Canada, it's in Quebec, which is by far the best jurisdiction and province in Canada to be a mining company and an exploration company. And not only is it in Quebec, it's in Chibougamau, which has the benefit of rail, road, airport, local labor force, sophisticated First Nations, a pro-mining culture and community. So it has all of these benefits and access to renewable, low-cost power, hydroelectric power on the grid from all of the hydro dams in northern Quebec. So it checks all of the boxes in terms of jurisdiction, but also access and infrastructure grade. So I think when the sentiment shifts, Antonio, in our industry, and we know we've had a rough ride as of late, and sentiment will shift because it always does. We own it. And there's going to be a huge amount of interest in this asset. There already is. Now, the question is, when are we going to sell it? Well, I don't know. And how far are we going to take? We'll take it to as far as we need to go. We'll build it if we have to, but we don't want to build it. That is not, that is not our area of expertise. Our area of expertise is the geology and de-risking it, and that we can take that all the way to the feasibility, which is a multi-year process, right? So we have time before we become in an awkward situation where you've got the feasibility and now it's construction decision or buy, right? And then shareholders are like, what's going to happen? And the company's sort of in an awkward position. It is forced to sort of develop it. 99% of junior developers don't want to build it. I mean, they may say the opposite, and the famous line is present a credible threat, which I think you need to do. But people who drill holes and do deals and finance, that is a skill set unto itself. And I would suggest that our group here in Toronto is part of the OR group, where I'll put us up against anybody. But in terms of building mines, we've never done that, and we probably won't be great at it the first time we try it. And in terms of operating mines, the same holds true. Those are three separate silos of skill sets. We'd like to stay in our lane. We have a long time because the construction decision is years away. So we've got a lot of work to do. We have a lot of value to build, and it's certainly my hope and maybe even I should suggest my expectation that we're going to get a serious tailwind with the price of copper. And frankly, all metals, I think, are going to have a nice little run over the next, call it 3 to 10 years. We're in the right business, I think, now after being so unloved, and I think there's going to be a reevaluation onto the fundamentals away from financialization and all the other sort of shenanigans that have gone on the macro basis and the financialization of everything. I think metals, real estate, real assets are going to be highly valued, especially those in top-notch jurisdictions like Quebec, Canada.
You're mentioning the macro, and I understand you're talking about macroeconomics, of course, but I'm thinking about the macro of the region, if you will. And correct me if I'm wrong, but let me maybe pose it as a question. But what about the other companies in the region? Because it's not a standalone thing where there's nobody around you. Chibougamau district is famous for this multiple deposits. You and I have talked about there potentially having to be a consolidator in the region. But how does this updated MRE change your dynamics or potential for any type of collaboration with the companies around you? Does it influence that in any way?
Well, we don't have any official collaboration with anybody. We certainly communicate with our neighbors, no question about it, but we're all independent and moving forward on our own account. Without question, we are the largest deposit. We always have been, and this resource reinforces that and re-emphasizes our grade and the fact that I think that we are the only existing economic deposit there. I think everything re-rates once there is a mill there or the prospect. People believe that, okay, this is legit, and they share the view that Charles and I and others on my board and team view that this is an economic deposit. Then those other deposits in the area, some of which are interesting, some of which are perpetual exploration projects, get a re-rating of sorts because they actually have the potential to be mined and milled. Whereas right now, to my knowledge, there's nothing in the area that stands alone. and justifies the capex required to build a mill and or refurb a mill or anything. It's so when it comes to copper base metals, scale is very important. So you need to be big enough, and I just don't see the scale on our contemporaries just yet without Opemiska being a part of it.
Where I'm coming from with these questions, by the way, just so you know, is because asking about how long is it going to take before a potential acquirer comes in, can you do something with the neighbors, stuff like that, is because moving towards that economic studies part of the Lassonde curve, so the PE, PFS of the Lassonde curve is called the boring part of the Lassonde curve, right? And starting from the market cap they are at right now, which is being punished, undervalued, in my, again, also biased opinion here, is just not, is already not fun, right? It's not great. And so how do you manage that boring part of the Lassonde curve in the meanwhile?
Growth and development of the economics. I think we're nowhere near the peak of the first hump of the Lassonde curve. Well, we're beyond discovery, that's for sure. We're not in the development stage here. We're still in the definition stage. So there's a lot more excitement to come before we reach that first hump and go down that roller coaster, which every project does face, and hence part of the desire to do a trade sale at some point in time. But let me emphasize, I have no interest in selling the company at $30 million or anywhere near it. That doesn't mean you can't sell bits and pieces, meaning that the typical equity investment would be 9.9 or 19.9%, and to get one or two strategics in there, and strategics come in different fashions, but call it operators or people of that sense, as I said, are in our database, which again, it was built for them, and to convince them of what we see without having them come back to us with too many questions. So it's meant to, as I said, meant to convince experts who get into the weeds, because 43-101s themselves are 300 pages of text. When anybody serious takes a look at an operation that they are considering not only acquiring but ultimately one day building, they're gonna want to unturn every rock, no pun intended. And so they're getting into the database. They probably won't even look at the 43-101. Maybe they'll look at the flora and the fauna section, but when it comes down to it, they're getting into the database.
This first hump of the Lassonde curve that you're mentioning is also an interesting part for me, and it's generally reminding me of what your stock price has done, and most recently this week. I mean, the stock is up some 50%. This doesn't happen a lot in this type of market, and oftentimes when it does happen, unfortunately, that's a reason to turn around and raise a bunch of capital because your stock price is now higher. You don't know how long is it going to stay there. Is that in the making for you? Are you planning a raise now off this 50% bump?
Not eminently, but look, we're in the business of raising capital. That's what I do for a living, and there will be a capital raise at some point in time for QC Copper, but it's not imminent. We don't need cash, right? I mean, we're not undertaking anything too capital intensive, certainly, right? Yeah, we were going to have a drill program, but let's look back at I think in our most recent, I think we got our Q3s published. We'll have which are, keep in mind, they're probably 6 months dated by the time your Q3 comes out. We'll have our annuals out shortly. But our last financials, I believe we had $12 million in working capital. The majority of that is cash or accounts receivable, which is all from the Quebec government. So it's as good as cash effectively. And then we've got, of course, our position in baseload energy, which very well. So we're not hard pressed. We've been well financed ever since the 2021 resource came out. Then we raised a whole bunch of money, and then we also sold 7 million shares of baseload for $8 million to our account, which was a bit of a home run. And that's the money we've been spending. We haven't done any financings since then, except for one financing, which was exclusively to Quebec-based institutions, quasi-governmental institutions, who have been supporters all along. And we wanted to get the right people positioned in our company, because they had been unable to participate in the 2021 financing because that was a charity flow through, which we did at a massive premium. I think we sold 60-cent shares with no warrant. So I do expect, I'll note that all of our cash is hard dollars. When we do a financing, and again, we will be doing a financing at some point in 2024, it's going to be using the charity flow through, or AKA structured flow through, as I hear them calling it now. In Quebec, again, a feather in the cap for Quebec, you get double the premium. Okay, that's the premiums going on right now. So if your share price is trading at 18 cents, you can sell it for 36 cents. I won't get into the mechanics of all that, but that's the effect to the company. And so it's outrageously and unfairly advantageous to companies that operate in Quebec. Other provinces have that. For example, we, as you know, we operate American Eagle as well, and British Columbia, also a great place, but you get 60% premium there. In Quebec, you get 100%. So the point is that's going to be flow through, which is money in the ground, because all of our existing dollars is hard dollars.
Right. How much? I'm looking at the filings here, last filings that show the 9 months ended in July here in 2023. There's probably a new one actually after that, but I mean, it looks like you're barely spending any money on G&A. How much does it cost you to keep the lights on?
Geez, I don't have a precise answer for you, but yeah, we run a fairly tight ship on G&A, and we also in many instances are splitting our costs by 6 or 7 or 8 ways, because we, as many of your viewers will know, we operate the OR Group, which has a basket of junior operating companies. So the office I'm sitting in right here, actually, I'm paying very low rent, but we split it between a whole host of companies. And there's other efficiencies. Our CFO, Joel, Joel Friedman, who's probably one of the best CFOs out there, works for all of our companies, and he's built a team under him. But the point is, I don't think that too many juniors could afford a finance team that we have that pays our bills early on time, not early necessarily, but on time and reliably, and same with our people. So we got a very well-oiled machine here that we've built because we do have economies of scale, but also we're able to attract high-quality people as a result of that structure, and then split the costs. So we do run tight G&A. Again, I don't know offhand. I mean, like, there's, let's just say historically 50 grand a month. Excuse me, is it 50 grand a month? I think 50 grand a month, something like that, $500,000-$600,000 a year to run a public company. We don't spend a lot. We don't do egregious investor relations campaigns. We certainly spend money on distributing our message. That's important. Investors want us to advertise, so to speak. But we don't do any of the funny business. I think that's important. We do a lot of stuff ourselves. We have spent a lot of time and internal resources developing our YouTube channel, which you've done an amazing job. I mean, you've done you've got 45,000 subscribers, which is phenomenal. And we're very proud to have I think 1,300 subscribers, which is better than your average junior. And we put out a video. I think that we put out a video for QC Copper myself, just me talking to the PowerPoint presentation for free, and I think we got maybe 400 views in 48 hours. So that is highly efficient. And so we have the ability, and we benefit too, because people come to that page because of, they want to see James Sykes talk, they want to see Tony Moreau talk, they want to see Charles talk. And so we aggregate it. And it just gives us more eyeballs, more presence at an effectively zero cost. We do everything in-house. And I remember the days, pre-COVID, doing the bums and seats road shows, where we'd have to buy dinner and a glass of wine for a bunch of people to come out. And there's still a time and a place for that, but that was how people did IR. But we very early as a group got onto the YouTube aspect because it's just so much more efficient. And frankly, we don't have to buy people a glass of wine to view our story. They're there because they want to see our story, not because they want a roast beef sandwich. So we have, I like to say and think that I treat our money as if it's our own. I am an owner, and that's just sort of the mantra we have here. And I think it's installed across the group, which comes back to the most important thing that I look for in people to work with. One, that I enjoy working with them, and two, that they care about the business and what they do and their reputation, and the fact that we all here want to be a part of putting something into production. We just have to be a part of that story. That's every project we take on. The first question we ask, does this have the potential to be a mine? And if we don't see it, we pass. And obviously, we understand there's large margin for error, but that it all starts there. And we may not discover it, and we may not put it into production. But the idea is to be a part of one of those segments, however long it may be. That's how we're going to deliver long-term sustained returns to us and our shareholders.
Well, don't get me wrong, though. I like a roast beef sandwich. I don't drink wine, so I guess I'll be cheaper if I come to one of those dinners. But I hear some people drink for 6, so that probably compensates for it. Why I'm talking about this is because I'm thinking about how you finance this going forward and whether equity is the only way to finance it. And given the byproduct credits of now silver is a new byproduct in this MRE, could there be an opportunity for other creative financings like a stream or a royalty, or would you rather keep the asset clean for its potential acquirer?
Well, let me answer your question directly. How do we finance it, step by step and by equity for the foreseeable future? That's how it's done, and you build value. So you take in $1 million, and the idea is you deliver, $10 million worth of value in market cap, right? That's an accretive investment, and that's how we'll do it up until a certain point. And where you're getting to is how do you build the thing, which is something that we're not contemplating at this point in time. It's always in the back of your head, of course, but that's not a challenge we're facing anytime soon. And there's a lot of value to be built through growth, through definition, and through better times in the market. And I think when the time comes and we do get closer, feasibility level, that's when you really start thinking about it, whether it's us or somebody else. And yes, you're absolutely right. Do we have a silver stream there? Yes. Do we have a gold stream there? Yes, we do. So those are nice little things to have in your back pocket. But, I think those will be kept in the back pocket for quite some time.
Okay, that's a fair answer. Short and direct. I appreciate that, and I think we've done a decent job overviewing sort of the basics here. I'll keep following along with the story as you go on. So there's many more discussions to come. If somebody has any questions that we're not targeting, please post them in the comments or wherever else on the internet. I'll probably find them. But so Stephen, you've probably had a lot of conversations with investors in the meantime since you've released this updated MRE. What's an interesting question that I'm not asking you, but somebody else asked you and you thought that was a good question?
What's next? Everybody wants to know what's in 2024. I think I've given a high level overview with you. I've certainly covered that as well in the webinar that I did over on the Your Group's YouTube channel. But again, because it's always about what have you done for me lately, right? That's the way it is in the investment community, and we understand that, and we don't just do it for the sake of feeding the beast, which you do have to feed the beast. But the fact is we do see value and opportunity. We have so much that we've been sort of putting on the back burner for the past year and a half, as we have been literally nose to the grindstone, just solely focused on this MRE. And so I have not unleashed Charles and Denny and Francois and the team, and there's many others there to do other things that need to get done, because we've just been so fixated, and I wouldn't let them sort of look anywhere else. So we have a lot of things we want to do, maybe even some tricks up our sleeves. But again, the main focus is going to be growth, to further define low-hanging fruit resources that we can relatively simply, relatively low risk, put that into the resource category. Maybe do some wildcat drilling on some targets that are just sort of begging to be tested. And then, of course, defining the mine plan, that is the engineering and ultimately the economics behind an open pit mining scenario as defined in this MRE.
All right, a little bit of a shorter one this week. That's because one company couldn't make it. As I told you last week, I was hoping Lumina Gold would be part of this, but they couldn't make it. And so we've rescheduled for in a couple of weeks. Looking forward to next week, though. As it sits right now, I'm supposed to have 5 companies in the weekly grill. That would be, let me just check it on here, make sure that I'm not saying the wrong name. So I've got 2 uranium stocks actually requested by the good people over on the Discord server. That's Pegasus, that's a uranium exploration company, and Myriad, that's the second one, uranium exploration company. I've got Thesis Gold coming up next week. They recently had news, so that's going to be an interesting conversation as well. Then Awali Resources, fair disclaimer, non-confession. That's also a stock that I own. They had news this past week, actually, but we're scheduled for an interview next week. And then American Eagle Gold Corp is is also going to be in there. They also had news, I believe, this week or the week before that. So, well, 5 interesting discussions. So next week is going to compensate for the shorter pause this week, basically. And thank you so much for watching. You have a great week, and I'll see you around. This is silly. I'm not going to see you around. I don't know. I'm not good at this. I'm just going to click it here.